Since June 2021, both domestically and internationally, consumer prices have been rising at levels not seen consistently for over 30 years. In the year to September 2022, the Australian Consumer Price Index rose at a rate of 7.2% a year, with price increases for fruit and vegetables and petrol severely denting household budgets. If you're borrowing for a home, you've directly felt the impact of the Reserve Bank's efforts to tame inflation, with increases in the official cash rate in 8 steps from 0.1% per annum in May 2022 to 3.1% per annum in December 2022. This increase in the cash rate has translated into sharp rises in variable interest rates for new home loans for owner-occupiers, with rates rising from an average 2.45% per annum in April 2022 to an estimated 5.06% per annum in December 2022. This implies an increase in repayments for each $100,000 borrowed from $4,710 a year in April 2022 to $6,486 in December 2022, an increase of $1,776 or 37.7%. For a $1 million loan, this necessitates finding another $17,760 a year to meet mortgage repayments and cash flow that may already be stretched. But while the interest rate increases place immediate cash flow pressure on home loan borrowers, are borrowers likely to be better or worse off should interest rates and inflation remain at current levels, compared with, for example, the situation in December 2020, when the RBA cash rate just hit its low of 0.1% per annum, the comparable home loan rate was 2.81% per annum, and inflation was only 0.89% per annum. The rest of this video examines, using the December 2022 and December 2020 scenarios, how the interaction between interest rates and inflation may lead to some less than obvious outcomes for borrowers. It then explains, however, that there are other factors relevant to the current situation that in reality modify the direct application of the analysis. Hi, I'm John Lesky, recently retired personal financial advisor and founder of FinHealth, a tool to guide you to your financial independence. The table on the screen provides the details for the two scenarios discussed above, to be referred to as the COVID and current periods, and includes the implied real home loan interest rates, that is, the actual rate adjusted for inflation. It reveals that while interest rates have risen 2.26% per annum since December 2020, inflation has increased by 6.38% per annum, resulting in a 3.95% per annum fall in real home loan rates. The charts now shown compare the implied actual and after inflation repayments for both scenarios on the big assumption that interest rates and inflation remain unchanged for the 30-year home loan period. They reveal that although the current period actual repayments are considerably higher than for the COVID period, when adjusted for inflation, the initially higher real loan repayments for the current period declined steeply. In fact, after 5 years, they are less than the COVID period real loan repayments. It suggests that, provided borrowers are able to cope with the first 5 years of higher real loan repayments, they are going to be considerably better off after inflation with the current period conditions than had the COVID period persisted. This next chart compares cumulative real loan repayments for the two scenarios. The total current period loan repayments are much less than the COVID loan repayments, despite a higher burden for the first 7 years. The analysis starkly reveals that when assessing the true cost of a housing or any loan, it's the real interest rate that's important rather than the actual rate. With a negative real interest rate, you actually repay less than you borrow. That is, in our example, real repayments of about $80,000 are required to repay an initial $100,000 loan. Many, often self-congratulatory baby boomers that borrowed at high actual interest rates during the 1980s benefited from long periods of negative real interest rates, with wage inflation often exceeding actual interest rates. The hardship of initially high loan repayments was more than offset by the benefit of rapidly declining real home loan repayments, as high inflation eroded the burden of actual repayments. But the above analysis isn't directly applicable to the current situation. First, for borrowers to be better off in the high inflation environment, they require wages and salaries to at least keep up with consumer prices. It's higher wages that erode the loan repayment burden, not higher consumer prices. However, as the chart now on the screen reveals, showing the growth in wages and consumer prices since September 2019, wages have yet to rise to match the acceleration in consumer prices that has occurred since September 2021. As has been widely reported, consumer price inflation has largely been driven by supply-side events, such as disruption of supply chains due to COVID, shortages and price increases driven by the Ukraine war and domestic floods, rather than increased demand due to wages growth. With wages growth currently around 3% per annum and home loan interest rates at 5.06% per annum, the average borrower is facing a current real interest rate more like positive 2% per annum rather than the negative 2.06% per annum if consumer prices are used to adjust actual rates. And even if consumer price inflation was the appropriate measure of inflation to adjust actual interest rates, it's the Reserve Bank's intent and the financial market's belief that it would reduce from the current 7.27% per annum to around 2 to 3% per annum in the not too distant future. An indicator of the market's expectations regarding consumer price inflation can be obtained by, for example, looking at the difference between interest rates on normal 10-year Treasury bonds and 10-year Treasury inflation index bonds. This chart plots the rates for the relevant 10-year bonds since 24 August 2021, with the dashed purple line representing the market's implied expectations of consumer price inflation from now to November 2032. Despite the rapid rise in actual inflation since September 2021, this measure suggests there has been little change in the market's expectations of long-term inflation. It clearly is anticipating inflation falling quickly from recent levels. So, while the real rather than actual interest rate determines the true cost of your home loan, you'll not know what that cost will be until after the loan has been fully repaid. However, to make a best guess of your real interest rate for the next 10 years at a point in time, a reasonable rule of thumb would be to add about 2% per annum to the 10-year Treasury index bond rate. As of mid-December 2022, this was about 0.83% per annum, implying an indicative 10-year real home loan rate of 2.83% per annum, much higher than the negative 2.06% per annum generated by using actual home loan interest rates and current consumer price inflation. And, of course, this rate will fluctuate considerably as the real interest rate on 10-year Treasury inflation index bonds varies over time with the perceived state of the economy. Hopefully you found this video of interest. I'd like to know what you think. Please provide any comments or questions below. And finally, thanks for watching.